like I said, it's all about supply. Every car that NIO makes, they are going to sell. Every unit of supply will have a unit of demand. That is 100% true. So now it's an optimization problem surrounding units of supply. How can they optimize that supply? On the demand side, I do like the fact that they've expanded successfully into Europe, and from reports that I'm reading are selling very strongly in Europe. I'm seeing murmurs based on LinkedIn job hirings and some reports that they're looking to get into America.
What's up, HGI investors, and welcome back to Hypergrowth Investing. I'm Aaron Davis, and as always, pleased to be joined by investment analyst Luke Lango. Luke, how was your long weekend?
The long weekend was good. Spent a lot of time researching. Stocks had their best week since November 2020. Last week, some of our stocks had enormous weeks, especially on Thursday and Friday to finish off things. Things are starting to feel a bit different. We've seen big rallies before. This one feels different. So I spent the weekend researching and looking into all the drivers of the stock market rebound to see if it's legit or a head fake. And we'll talk about which one it is over the next hour. But spoiler alert, I'm pretty bullish.
Well, definitely looking forward to getting that in just a few moments. If this is your first time joining us, Hypergrowth Investing is the weekly podcast that picks the brain of investment analyst Luke Lango. Each week, we take an in-depth look at emerging tech and investment innovations, electric vehicles, cryptocurrencies, the metaverse, and more. Nothing is off limits. If you're joining us for the first time, we go up every Wednesday on YouTube, Spotify, Apple, Google, wherever you choose to listen to your favorite podcast. So make sure to hit like and subscribe to get Hypergrowth Investing as soon as it goes up. Again, I'm Aaron Davis, educator and lifelong learner, and your proxy into the mind that is the Luke Lango. Ton of things to cover, so let's dive right in. Luke, last week you gave us an update with Lucid Motors, but one of the companies in the EV sector that we talk about a lot that we haven't checked in on for a few weeks is NIO. Essentially, a lot of it having to do with some of the lockdown situation in China. Can you discuss any news or updates since we last talked about them in the last month or so?
Right. So I think the context here is that electric vehicle production is very dependent upon supply chains being normal. When supply chains are good, these companies can make a lot of cars and they can sell a lot of cars. Demand is not the problem in the electric vehicle industry. Every car these companies, especially the good ones like NIO and Lucid, can make, they will sell. Demand is always going to be there. Every unit of supply will be met with a unit of demand for the foreseeable future. So the question mark becomes on how many units of supply can these car makers produce. And throughout 2021, that supply constraints were really limiting the units of supply these companies could produce, and that weighed on their stocks. And that's continued in 2022. And with respect to NIO, it's actually accelerated in 2022 because of the lockdowns over in China. But there's now good news on that front. So Shanghai is moving to end what has been a 2-month lockdown in that city. It appears COVID restrictions are very dramatically easing off in China. So it does look like maybe they go back into a lockdown in the summer or maybe in the fall, but any lockdowns that do emerge in China are going to be very short and not all that intense or restrictive. So I think the market is now digesting this reality that any future lockdowns in China will not be a major deterrent to production of anything, but specifically production of electric vehicles. So NIO stock is catching a bid on that. All the Chinese EV stocks are catching a bid on that. All EV stocks in general are catching a bid on that. And I think bigger picture, if you kind of zoom out there, the COVID lockdown situation in China was the last domino to fall, if you will, of supply chains rapidly improving. Across the globe, supply chains are improving. The COVID-induced supply chain disruptions of 2020 and 2021 are gradually improving in 2022. And I can give you a firsthand example of this. My wife and I tried to do furniture shopping in 2021. Mm-hmm. Every place we went to, regardless of the store, was a 2-month, 3-month, 4-month, sometimes up to 6-month backlog for us to, if we ordered the piece that day, it wasn't going to show up in our home for up to 6 months. I mean, it deterred us so much from shopping that we just said, forget about it. Like, this is ridiculous. 6 months to get a couch, or 6 months to get a table, a coffee table. Not for us. We recently decided to roll the dice again and do, go out and do some window shopping for furniture. And this past weekend, actually it was 2 weekends ago when we went, not Memorial Day weekend, but the weekend before that, we were shocked. We were asking, okay, well, this list looks great. Well, how long is it going to take? What do 2-3 months out? And everywhere we went, they were saying, no, we can actually get these in 3 to 4 weeks for you, or 2 to 3 weeks, or in some cases, 4 or 5 days. So we started to see these furniture supply chains, or these furniture backlogs that were deterring us from buying, now becoming much more reasonable and pre-COVID normal levels. So we're seeing that normalization play out. The China COVID situation was kind of the last domino to fall. If that domino falls, and it is falling as we speak, then supply chains globally should rapidly improve throughout the year. That'll dramatically help NIO stock. That'll dramatically help all electric vehicle stocks. And it'll dramatically help all stocks in general, because if you think about it, supply chains improve means supply goes up. Supply goes up, that is a deflationary driver. The inflationary problems we've been seeing should decelerate. That means yields go lower. That means stocks go higher. So this is a very important situation to monitor, and one that I'm getting pretty constructive on based on what I'm seeing in the market, what I'm seeing in the data, what I'm reading in the news. Supply chains across the world are getting better. They're going to keep getting better. As they do, inflation is going to become less and less of a problem.
Now, why won't potential future lockdowns have the same dramatic effect that we've seen in the past when NIO had to shut down for, weeks at a time? What's going to be? You said that future potential lockdowns aren't going to affect it as heavily.
There's a lot of it. It's not 2020, right? Mm-hmm. I mean, the Chinese consumers, citizens, they have access to the internet. They have Weibo. They have these websites. They know that COVID-19 is not a serious enough illness to warrant stopping the economy. Mm-hmm. They're well aware of that. There's been a lot of citizen pushback to the lockdowns. The Chinese government is aware of it in the sense that they don't want their economic expansion to be hampered significantly at a time when everybody else's economy is, back to normal or back to quasi-normal levels. So a lot has changed. The context has changed. The dynamics have changed. And as a result, the Chinese government can no longer institute harsh, prolonged lockdowns, because the citizens are going to push back and their economy is going to get hit hard, and it's going to significantly disadvantage them. So, I do not think that these lockdowns are going to be serious in any nature going forward, and the current one is ending. So I think we're going to get a multi-week, if not multi-month stretch here of normal China operations. Maybe we get another lockdown in the fall. That's when, diseases start to spread a little bit more quickly. But I think that lockdown will be much like this lockdown. 1-2 months, kind of hot spots all over, and then, reopen back up right after that. So I don't think that COVID-19 lockdowns in China are a risk that the market needs to monitor anymore. I think we've kind of moved past that.
So are there any other factors that are affecting NIO for good or worse right now, aside from COVID lockdowns?
Holy moly, Aaron. I'm sorry. I just looked over at my my little monitor over here, and fun fact, the NASDAQ was down about 1.5% at its low today, and now we're up 54 bips. So that's a very powerful 2% swing in the bullish direction. Price action is looking good. Anyways, sorry, Aaron, repeat your question.
No, all good. It's good to know that you're monitoring the situation regardless of what you're doing. So,
what was the question?
Are there any other factors that are affecting NIO moving forward aside from the COVID scenarios?
No, I mean, like I said, it's all about supply. Every car that NIO makes, they are going to sell. Every unit of supply will have a unit of demand. That is 100% true. So now it's an optimization problem surrounding units of supply. How can they optimize that supply? On the demand side, I do like the fact that they've expanded successfully into Europe, and from reports that I'm reading are selling very strongly in Europe. I'm seeing murmurs based on LinkedIn job hirings and some reports that they're looking to get into America. So the story, again, I've said is 2022 is going to be the year of NIO expanding into Europe. 2023 is going to be the year of NIO expanding into America. And so I think with that demand expansion, if you get supply chain normalization, continued supply chain normalization, NIO's looking at a probably 2 to 3 year runway here where sales growth will be tremendous. Margins should dramatically improve, and the stock should work really well, especially from its currently depressed levels. So I really like where we are with NIO stock, where that stock can go into 2023, 2024, 2025. I think you got a good runway here with that name.
So how does that expansion into the U.S. affect a company like Tesla? Again, we've kind of separated Lucid in the past as kind of that next high-end luxury model EV. NIO and Tesla seem to be on the more level playing field with each other. How does NIO's expansion affect a company like Tesla?
Yeah, not well. Not well. Excellent point. Excellent question, Aaron. No, not well at all. And that's why we are not as constructively bullish on Tesla stock as we have been before. You know, we were bulls back when everybody was calling it a joke stock and everybody thought it was going to go bankrupt several years ago. We were exceptionally bullish on it then. But now that we've become so elevated in the stock price, so bloated in the valuation, and competition is really showing up for the first time ever, not as bullish on Tesla stock as we have been. I think it's foolish to bet against Tesla stock. It's foolish to bet against Elon Musk. It's foolish to bet against the engineering power they have over there. It's foolish to bet against their massive balance sheet. I think that's foolish, especially considering that it's not just a car company. They have the solar business. They have the energy storage business. They're doing lots of innovative things. Foolish to bet against them. But betting on them, right, there's this middle ground where you don't have to bet on them, you don't have to bet against them. They're kind of like just stuck in this neutral territory. That's where Tesla stock is for us right now. With Lucid ramping production, with Rivian ramping production, with NIO considering an entry into the U.S. probably in 23 or 24, with Ford coming out with its electric cars, with GM coming out with its electric cars. On that note, I just read a Barron's report. They just test drove the electric Hummer.
Okay.
And they said that it drove like a sports car but looked like a tank. And they said that that was their most enjoyable test drive above Lucid, above any Tesla car, above the Ford F-150 Lightning, above everything. They ranked electric Hummer as number one. So what that goes to show you is that these traditional autos do know a thing or two about making cars. And that means they do know a thing or two about making electric vehicles. So they're making pretty good electric vehicles. So with all this competition showing up at the same time, 2022, 2023, 2024, yes, the electric vehicle pie is growing, but Tesla's slice of it is going to shrink. That's probably going to show up adversely in revenue growth rates. And I think that unless the solar business and energy storage business can offset that, they're going to get slowing growth out of Tesla over the next 3 to 4 years. Not sure the valuation is priced for it. Again, doesn't mean the stock crashes. It's a fabulous company. Fabulous companies tend to have stocks that go up over time. But I think you can kind of wait and see with the stock here. Let's wait and see how the stock reacts to increased competition. And then let's get into it after it takes a hit on that increased competition and ride it higher on the next wave. But right now, it's kind of stuck in no man's land for us.
All right, I guess then we'll just have to wait and see. One of the things that we didn't have to wait and see for is last week's PCE numbers that came out. How did you interpret the numbers that came out?
Very bullishly. Very bullishly. So let me pull up a chart for you. And we can do some screen sharing. Let's see here. Screen share. Gosh, don't you love technology? So I think I'll pull it up for us right here. Yeah, so here's the PCE number. So PCE, personal consumption expenditures, tracks the price of a basket of goods the U.S. consumer pays for. La-di-da-la-di-do. It's what the Fed watches for inflation. It's basically the inflation rate of the United States. So as you can see, the inflation rate of the United States decreased right here in November 2020. We went from 1.17% year over year to 1.11% year over year from October to November. And that was the last time the inflation rate decreased in the United States on a year over year basis. Throughout the final months of 2020, every month of 2021, and the first few months of 2022, the inflation rate increased every single month. It was a record 16 straight months of accelerating inflation in the United States of America. That hurts. That adds up. That's a big reason why stocks have been under pressure. Then you see right here, we topped. Boom. 6.61% in March and then down to 6.27% in April.
Okay.
So we topped. For the first time in 16 months, the inflation rate in the United States dropped on a month-over-month basis.
Okay.
So that's big. Psychologically, it's huge. Yeah, it was a tiny little drop off, but psychologically, it's massive. We've gone from consistently accelerating inflation to a top to decelerating inflation. Based on the trends I'm seeing, I think that deceleration persists. We've hit peak inflation, now we go down. And I think that's the consensus on Wall Street. A lot of people think that, but I believe the pace of the deceleration is going to shock a lot of people. It's going to shock a lot of people. So actually, I'm going to pull up one more chart for us that I think is very, very interesting and something that I believe is worth sharing. So let me pull this up. So can we see this chart here?
It is loading right now, but yep, we can see. Yep. All right.
Okay. Sorry, it's not. Let me see if I can open image a new tab maybe, and that can be a bit bigger. Nope, thought that would be bigger. Oh well, that's fine. So this is a measure of the year-over-year growth in the M2 money supply in the United States. So M2 money supply, technical definition is M1, M2, M3, different levels of money supply. M2 is the one that is the most actionable money supply. So just view that as the amount of money circulating in the U.S. economy, actionable money circulating in the U.S. economy. As you can see, during the past 20 years, we've averaged anywhere between 5% to 10% year-over-year growth in the M2 money supply, right? We kind of bounce around. Sometimes we break below. Sometimes we kind of come up right to 10%. But that's where we've averaged for the past 10 years, right? Or 20 years, sorry. Now, in 2020, we spiked throughout all of 2020. We were above 20%. Because of all the money printing that went on, all that. And then throughout 2021, we were pretty much above 10%, right? We were in the 10% plus range. But now here in 2022, we've fallen. I believe the last reading was around 8%. We've fallen back into the historically normal range of 5 to 10%. So this is a sign that demand is moderating.
Okay.
That the amount of money in the economy, the growth of that money is slowing to historically normal ranges. So for me, that means falling demand.
Okay.
Then you have rising supply based on the supply chain issues we just talked about, them getting better, them resolving, supply chains getting back to normal. So you have a situation where I think the stage is set for massive supply growth, massive demand destruction. That leads to very rapidly decelerating inflation. I think we go from 6% to 2% in about 12 months. And I think by the middle of 2023, second quarter of 2023, we're back to 2% or lower inflation rates. That's important for stocks, obviously, because as we've gone from 2% to 6% inflation, stocks have gone boop, 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 and they just crashed. As we go from 6% to 2% inflation, do the flip, stocks are going to do the flip. We're going to go, woo! We're going to soar. Stocks are going to soar. So I think that not only is the inflation, we've reached peak inflation, and that inflation is going to decelerate, but it's going to decelerate more rapidly than the consensus expectations have priced in, which is going to lead to upside price appreciation in stocks and all risk assets, really. So I'm really constructive in what I'm seeing on the inflation picture as well.
So essentially, investors have a lot to look forward to in the next 12 months.
In my opinion, yes. I think that the inflation situation is going to meaningfully improve. That has been the biggest bane of stocks over the past 12 months. As it becomes a tailwind, that's going to really help stocks move higher. So I do think the next 12 months could be pretty attractive. That's why I was researching throughout the long weekend to try and figure out, hey, the price action in the market is saying something, but is that something a head fake or is that something real? And I think it's something real. I'm pretty sure it's something real because not only do you have inflation decelerating for the first time since late 2020, but you also have the Fed is sounding a bit more dovish. They made a dovish pivot for the first time since 2020 as well, right? They've consistently sounded more hawkish essentially every meeting, and now the commentary shifted a little bit more dovish to a point where it's like we're going to hike 50 in June, hike 50 in July, but then we're going to maybe wait and see how the economy reacts to those to decide what we're going to do in September. That is a dovish pivot. That is a dovish surprise. So I think the Fed is now shifting policy a bit. You're seeing valuations come down to levels that are much more reasonable and much more historically normal. So you're starting to see a lot of things kind of come into play here where I think that the stage is set again for stocks to perform significantly better over the next 12 months than they have over the past 12 months. And I think it's going to be a pretty big rally.
Another trend that you kind of have been looking at over the last few months that we've talked about here is insider buying.
That's another thing. Yeah. Thanks for bringing that up. Yeah.
It's continued at unprecedented levels. Is there anything new you want to share on that contributes to this?
Yeah, well, that's exactly another little research thing I can pull up here. There you go. I got the image right there. We'll share again. Lots of screen sharing this time, Aaron. Lots of screen sharing.
I'm glad we finally got it working.
Yeah, indeed. All right, here's our screen.
Okay.
Here's the insider buying, insider selling ratio. Buyers divided by sellers. The higher the ratio, the better. It means insiders are buying. The lower the ratio, the worse. Means insiders are selling. Look at that. Look at that. Massive spike here. Massive spike in insider buying as stocks have come down. Okay, now we can say prima facie that is bullish because it means insiders are buying. But it's even more bullish when we look at what this means historically speaking. Let's see where we have these similar big spikes. Similar big spike here, March 2020, coincided with a stock market bottom after a stock market sell-off. Big spike here, late 2018, coincided with a market bottom right after a market sell-off. Big spike here, late 2015, coincided with the market bottom right after a market sell-off. Amazing. These insiders have an uncanny track record of calling market bottoms, and they're calling it again right now. So that is supremely bullish in my opinion. I mean, insiders are the people you want to align with. These are the CEOs, the COOs, the CFOs, the CTOs, the board members, the big hedge funds that have 10% or more ownership. These people know more about these stocks than any of us, than all of us put together even. Okay? They intimately know the day-to-day operation stuff that you and I cannot know. It would be illegal for us to know.
Yeah.
They're buying like crazy. Okay? That's a signal you want to follow. Not just historically speaking, they call market bottoms, that's bullish, but just fundamentally speaking, if those people are buying, you want to be buying too. You want to align yourself with the people who know most about the businesses and what they're doing. They're buying, so should you. So I'm really bullish on that insider buying trend. It's only getting bigger and bigger and bigger and bigger and bigger. And I think that's an insanely bullish indicator for stocks over the next 12 months.
Is there any insider buying happening that you disagree with where you're like, I don't see the future in this company. I don't have that long-term outlook that I do with most of the picks that I have?
I'm sorry, Aaron, you kind of broke up there.
Sorry. Yeah. No. So my question to you is, are there any companies that are doing insider buying that you don't have that same long-term outlook that you're just like, maybe it's just hype and I'm not quite a fan of this?
When it comes to insider buying, I'm sure there is. I'm sure that exists. It's not what I focus on, so I can't really tell you for sure.
Gotcha.
The chart I just showed you is macro level insider buying. Just all the insider buying in the market. They're consensusly saying that stocks are oversold, undervalued, it's time to buy. So that's a macro call. On a micro basis, individual stock basis, I do pay attention to what they're buying, but more so in a bullish sense. I'm looking for the non-head fakes. I'm looking for the insider buying that matters, the insider buying that counts, where there's insider buying in companies that I think have tremendous long-term value creation. And one of those companies that we've talked about a lot here is SoFi. SoFi's CEO, who is a very, again, we talked about it before.
It seems like he just keeps buying.
he's buying. his thing is he's buying it pretty much in like $200,000 to $250,000 increments. And yeah, he keeps buying on oversold periods. He comes in and buys multiple $250,000 chunks. I mean, I think the number is he's bought about over $1.5 million worth of stock over the past 2 months alone. So yeah, he's coming in hard, and that's something that's super bullish for me because that's a company that has tremendous long-term growth prospects. The stock is severely undervalued. The student loan moratorium issue seems to be coming. It's going to pass within the next few months. You get the $10,000 loan forgiveness, and then boom, right back to payments. So it seems like that issue is moving into the rearview mirror. And the insider buying there is pretty meaningful. So I'm looking for situations like that where you have really solid companies with great growth prospects, undervalued stocks, where there's insider buying. That's a situation I want to get into right now. It's not just insider buys, buy the stock. Insider buys, if it's a good stock, buy the stock. So that's where we're at right now. And yeah, SoFi is one of those names that we're really excited about the insider buying trends there right now.
Shifting gears a little bit, the European Union just announced recently the Russian oil embargo. How do you expect this to impact energy prices moving forward? Again, it looks like oil prices are jumping on this news. We also have a relevant fan question from Danny Long. Another informative video, Aaron and Luke. Year-to-date energy, oil and gas is doing quite well. Is it too late to invest in energy for the rest of the third and fourth quarter of 2022? Thank you. Essentially, what's the outlook for energy right now with this ban on Russian oil?
Great question. Is it too late to jump on energy and oil stocks for the third and fourth quarter? Probably not. These things tend to run in 12-month cycles. So if it's a top-performing asset in 2022, it's probably going to be a top-performing asset for the second half of the year too. I do think energy and oil can run higher, especially with the EU embargo on oil. 75% basically immediately comes offline. 90% by the end of the year comes offline. It's just going to get redirected into Asia. So it's not like supply globally comes offline, but it's definitely going to create price pressure elevation in certain economies, Europe, namely America as well. So I think that the embargo sets the stage for oil to probably go up to 130 a barrel in 2022. I don't think it's going to be a spike. I think it's going to be a gradual rise, but I think we do get there. That's the short-term outlook. The long-term outlook is if and when oil gets to 130, I am going short. Because this is a massive bubble forming in energy. This is a massive bubble forming in fossil fuels. This is a massive bubble forming in natural gas and oil. And to illustrate why, let's do another screen share, shall we? We're all about the screen shares today.
Absolutely.
We're all about the screen shares. Okay, so here's a chart from the IEA, the International Energy Agency, that basically graphs world oil supply versus world oil demand. And that's what matters, right? What drives price, supply and demand. We can talk about geopolitics, we can talk about all these other things, but at the end of the day, what drives price is supply and demand. Those things only matter to the extent that they impact supply or demand, or both. So we can see that here we have normally, 2010 through 2020, we had excess supply in the market. This is in tons, but you kind of do the reverse the calculation into millions of barrels a day. The markets were oversupplied by about 2 to 3 to 4 millions of barrels per day throughout 2010 and throughout the 2010s. Right now, it looks like we're kind of getting into a balance where it's 0 millions of barrels per day of oversupply or excess supply, and that's why you're getting the price spike that you're seeing. But the IEA is also coming out here and saying by 2030, this shift to electric vehicles alone is going to cause demand destruction of 5 million barrels per day of oil.
Okay.
So you're going to get 5 million barrels per day coming offline in demand because of the shift to electric vehicles. Maybe you factor in more destruction from the shift to solar, hydrogen, wind, even nuclear. So just a broader energy shift. Net, I think you're talking about demand looking like it's around 100 million barrels per day today. I think it looks something like maybe 90 to 95 millions of barrels per day by 2030 or by the back half of the 2020s. So you're looking at a demand picture of 90. On the supply side, you're looking at 100 right now. And there's been a lot of reports that you're going to get more supply coming online. People are going to increase production. There are more rigs coming online. So even if that doesn't happen and supply stays at 90 or supply stays at 100, you're looking at demand at between 90 and 95. Let's call it 95 to be conservative. Let's look at 100 on supply. That means you're looking at an excess supply of 5 million barrels per day. And we talked about the average throughout the 2010s was about 2 to 3 millions of barrels per day. So we're going into a situation where you're going to have a bigger excess supply than what was averaged throughout the 2010s. And if you actually do this graph next to the price of oil, which we've done, but I don't have it readily available for you, you can see that that there is a direct correlation between excess supply and price. So if we're going from an average of 2.5, 3 millions of barrels per day in excess supply throughout the 2010s, and prices were averaging 40, 50, 60, 70, $80 a barrel, and we're going to go into a market that has 5 million barrels of excess supply, then that means the price in that market should be sub 40.
Yeah.
It should be 20, 30, $40 a barrel. We're at 130 right now. So this this rally that we're seeing is entirely unsustainable. And normally these rallies end in one kind of below the top off finale where they have their final inning and everything goes crazy. The EU embargo on oil could produce that. We could see a shot up to 130, 140. If that happens, immediately go short because you're going to see destruction in the price of oil from 130, 140 to probably about $20 or $30 over the next 5 years. It's going to be a massive wipeout. Energy stocks, natural gas stocks, oil stocks related to that are going to get destroyed. I think that within the next 3 to 6 months is going to be a great time to enter a short position against oil. But you need that one final blow your top off rally to kind of signal the peak euphoria in oil. But I mean, fundamentally, it's absolutely silly the prices are this high. Just fundamentally speaking, you're going to get massive demand destruction, massive demand destruction, and it's going to be much bigger than what's anticipated. And supply is not going to be able to come down in a way to balance the market. So it's going to be ugly. And I would go short oil again within the next 3 to 6 months once you get your blow your top off rally to 130 or 140 on the price of Brent crude per barrel.
But it's certainly a long-term boon for clean energy, right?
That's where the demand destruction comes from. That demand's got to go somewhere. Population growth is still a thing. Urbanization is still a thing. Energy needs are still going up. So it's not just the demand's coming offline and going nowhere. It's coming offline and shifting. And it's going to shift towards the clean energies. And I actually think this EU embargo on oil is going to be a huge accelerant for clean energies. Europe is the leader in hydrogen infrastructure, the leader in researching and developing hydrogen technologies. I think them cutting off Russian oil means they're ready to shift towards hydrogen. They're ready to shift towards solar. They're ready to shift towards wind. I think you're going to get a massive boom in European clean energy technologies over the next 12 months. And that's just going to parlay itself into a massive boom in the U.S. because the two are basically interconnected. So I think, it's a huge tailwind for clean energy stocks, clean energy technologies, all that stuff. Massively bullish there. I think, again, in the next 3 to 6 months, great time to go super long clean energy and super short fossil fuels. That pair trade, I think, is going to produce enormous profits over the next 5 years.
So what do fossil fuels look like when this shift happens in the energy sector? Do we see this kind of leveling off in 2030 where, you have, 50-50 in gas, 50-50 EVs, and the prices for the general consumer are just, pretty equalized in both fronts?
I mean, it's going to be a gradual shift. So EVs are going to go from they were 10% of sales in 2021. They're going to go to 15, 20, 25, 30. IEA is calling for 30% by 2030. We think it's more like 40 or 50% because that's where automaker targets are. All the automakers across the globe have targeted essentially 50% plus EV penetration by 2030. They're the ones that actually make the cars, not the governments. Or these research firms. So I think that I'm going to follow those targets the most. I think we're looking at 50% electric vehicle penetration by 2021. I think solar, which is already accounting for more than half of new energy installations in the United States every single year for the past several years, by 2030, 90% plus of all new energy will be clean energy installations, if not 100%. So I think you're going to get this gradual shift, but it's going to be much more quickly than a lot anticipate towards clean energies on all fronts. In terms of prices, that's actually going to mean lower energy costs for all consumers because, as we've talked about before, clean energies, solar, wind, hydrogen, electric vehicles, they have very positive learning rates. The more we learn about these things, the more efficiently we can produce them, the more economies of scale we can leverage, and the lower our component costs can be. So, and the more we can integrate automated manufacturing and different things like that to bring down production costs. So I think that energy costs are going to dramatically decrease for the consumer over the next several years because we're shifting towards energies that are renewable and where supply can be much more abundant than where it is in the fossil fuels market. So I think that's what the world looks like in 2030, and it's going to be a much better world for everybody because energy is going to be more abundant and much cheaper than what it is today. And you're going to have a lot more energy independence. We've talked about this before. This whole idea of energy independence via fossil fuels is an illusion. Not everybody has fossil fuels. Not everybody can achieve fossil fuel energy independence. And that independence only lasts so long because there's only so much of that stuff in the ground. And if we go completely fossil fuel independent in the United States today, we're going to run out of fossil fuels by 2050, 2060, 2070, at which point we will become 100% reliant on Saudi Arabia or Russia. Mm-hmm. Not a good situation. Yeah. So this really is to me, it's an absolute no-brainer. Mm-hmm. It is so obvious what needs to happen, and it's what will happen. Mm-hmm. So again, like I said, next 3 to 6 months, great time to go secular long, clean energy, secular short, fossil fuels, and oil. Oil is going to, by the end of the decade, be destroyed. The price of oil will be absolutely destroyed. Mm.
Well, talking a little bit about destruction, we talked a little bit last week about Snap. We got some bearish news about it. And that basically kind of positioned you in the sense that a recession is no longer completely out of the question. And I hear you're seeing some interesting data alongside insider buying that may suggest that stocks are being undervalued at these levels, specifically mm-hmm. the S&P multiple and Morningstar. Can you talk a little bit about that?
Sure. Yeah. So the insider buying, we already touched on that. Mm-hmm. Insiders have a track record of calling market bottoms, and they're calling a market bottom today. So, good news. Morningstar. We're talking about Morningstar for a bit. Let me do another screen share. Woo, woo. Let me hear a woo woo for screen shares. Woo. So here we are on another screen share. Morningstar is a fundamental based research firm. They do. They go through the market and they scan all these stocks, and 809 stocks, something like that, and they give them fair value ratings based on the fundamentals of that company. Mm-hmm. Anyways, as you can see here, this is the number of stocks in their coverage that have 5-star ratings. So They rate every stock from 1 star to 5 star, where 1 star is it's really overvalued and 5 stars is it's really undervalued based mm-hmm. on the fundamental analysis conducted by Morningstar. Look at that. The number of 5-star stocks in the market today, according to Morningstar, is its highest since it's been since March 2020, mm-hmm. which coincided with a market bottom. Amazing. Mm-hmm. So here we have another similar spike. Boom. Coincides with the market bottom? I think so. So that's the Morningstar data, and I think it's pretty bullish. Morningstar is basically coming out here and saying on an individual stock level, individual stock basis, stocks are as undervalued as they've been since the depths of the COVID-19 pandemic, which proved to be a tremendous single stock buying opportunity. Mm-hmm. History is repeating. I like it. Very bullish signal. I want to talk about the multiples, more screen sharing. So here's the S&P 500's forward price to earnings multiple. Mm-hmm. The green line is its 5-year average forward earnings multiple. Mm-hmm. The blue line is its 10-year average forward earnings multiple. So as you can see, there was a period of time throughout 2020 and 2021 where we were very overvalued on the index level. Okay. So you're talking about 21 times, 22 times. We got up to 23 times, above 23 times at one point, forward earnings, which versus the 5-year average is right around 18.7, 18.6. The 10-year average is right around 17 times. But we've collapsed. We collapsed below the 5-year and now we're below the 10-year. So we're trading at around 16.8, 16.9 times forward earnings right now. That's below the 10-year average multiple. So on an index level, valuations have compressed to below their historical standards and in line with where we were throughout 2015, 2016, and 2017 in this range. So that's a very bullish indicator. The same is true for what it's worth. Some people will say, hey, the forward estimates have to come down, so the forward P multiple doesn't mean anything. Okay, fine, I get that. That's cool. Let's look at the trailing one. So here we got the trailing 12-month PE ratio for 5-year average and 10-year average. Look at this. We went way above the 5 years and 10-year averages, and now we've come below both the 5-year and 10-year averages. So on a trailing basis, we're right around 18 times trailing earnings. 10-year average is around 20. We are where we were back in 2015, 2016, around those levels. We're pretty close to where we bottomed in late 2018. Valuations have reset on a forward and trailing basis. So what the two charts I just showed you broadly underscore is on a bottoms up basis, on a top down basis, no matter which way you look at it, you're converging on the same conclusion. Stocks are undervalued. They were overvalued. They've reset, and now they're at a point where they're ready to rally. What you need for them to rally then is, well, what that means, it doesn't mean they're going to turn around right away, the valuation analysis we just did. But what it means is that from current levels, the forward growth prospects, price appreciation potential is very attractive. Now, what you need for the timing of the turnaround is for inflation to decelerate. We just talked about it. Inflation is decelerating. Will the rebound continue? That depends on the course of inflation, which you already talked about. Supply is improving. Demand is being destroyed. That means inflation is probably going to decelerate over the next several months. So all of these stars are starting to align, Aaron, and it's making me pretty bullish that the price action in the market we're seeing is not a head fake, but rather the first inning of what could be a generational market turnaround, wherein stocks could power significantly higher over the next 12 months. And that rally will be led by the ones that got crushed the hardest over the previous 12 months. The hyper rate sensitive, tech growth stocks, long duration assets, risk on assets, those names have been crushed over the past several months, several quarters. They're going to be the ones that lead the rally on the other side. So this is going to happen. The question is whether or not it happens in the next 12 months or the 12 months after that or the 12 months after that. This turnaround is going to happen. It's a question of timing. The timing's starting to look good. I'm getting pretty bullish.
Are there any other signals that we can kind of look at that kind of are going to initiate this rally? We're talking about decelerating inflation. We're talking about better supply demand. What is there going to be, like some inciting incident, or is it just going to be a gradual rise?
It's going to depend on the course of inflation and the Fed's response to that inflation,
which we talked about each week. Okay.
Yeah, so we got to look at the monthly CPI and PCE prints. Normally the CPI comes out first. So on days that those prints come out, if they are better than expected, those are going to be days that spark meaningful rallies in the market. And then you got to look at the Fed meetings. They have their 2-day meetings. They have one in June. They have one in July. They take August off. They go in September. First day they just meet. Second day they have the press conference. Those are going to be big days for the market. So there's pretty much, I would say, 4 dates you want to mark down over the next 2 months. CPI June, Fed presser June, CPI July, Fed presser July. Those dates, if those kind of all point to slowing inflation and a more dovish sounding Fed, that creates a trajectory for stocks to follow those data points and move meaningfully higher.
Could you also tell us just a little bit about the Goldman Sachs hedge fund report recently released?
The Goldman Sachs, the hedge fund VIP report? Is that?
Yes.
Yeah, I think that's what we're talking about. Yeah, sure. So, Yeah, I mean, there's not a lot to glean there. Basically, Goldman Sachs has this index that tracks the VIP hedge fund stocks, the very important hedge fund stocks. Those are the stocks that the hedge funds, the hedgies own the most. They buy the most. They're most anchored around. And that portfolio of stocks has been crushed recently.
Okay.
And it speaks to just how hedge funds have been crushed recently in this market chaos. And more broadly, it speaks to the fact that people were just over levered to the long tech trade. Not that trade was wrong, but when anytime you get over levered, markets get over levered to a certain type of thing, they get overexposed to a certain asset, you're due for some mean reversion, some normalization in that. We got that. And now I think that they've been crushed, that a lot of these hedge funds have been crushed, a lot of those VIP stocks have been crushed. That actually is a very contrarian bullish indicator to show us that, okay, wipeouts happen, resets happen. Now let's get back to business. Let's get back to fundamentals and let's let stocks go higher. So that's pretty much all there is to glean there. Not a terribly important print, but a terribly important report, but definitely something that kind of adds to this mountain of data we have going in the bullish direction right now.
Gotcha. Shifting again. This actually kind of came up to me. I was actually, talking to a friend at a wedding recently, telling him, about our podcast and what we talk about. And one of the things he kind of brought up to me was a topic that I haven't heard about in months, and that was GameStop. And basically, he got super bullish on GameStop, not because of what happened in the past, but because of how they basically are leveraging what happened with their rally to basically shift their business dynamic. So they have a new CEO, they're having new initiatives within the NFT and metaverse, which basically kind of speaks to this kind of broader question that I have, which is, there's a lot of chatter on how these meme stocks are kind of leveraging that continuing community momentum and fundraising to bring about real changes. Can you talk about how you view this and if this is all hype or if there's some, strategy behind some of these meme stocks and what they're doing with their community involvement?
Okay, yeah, sure. Definitely. It's not hype. I mean, the strategy is, okay, we generated this hype and now we're going to leverage this hype to raise capital, attract talent, and try to turn the business around. That's definitely the strategy. And it's the best strategy for those companies. If I were the head of GameStop, the chairman of the board, or the chairman of the board at AMC, that's exactly what I'd be doing. I'd be playing right into the retail traders' hands. I'd be leveraging the frenzy and the momentum. I'd be issuing share sales. I'd be raising a bunch of capital. I'd be attracting new talent, and I would try to turn the ship around. It's still a very tough thing to do. Turnarounds are very hard to execute, especially when you're GameStop and AMC. Okay. What is the GameStop play? Try to make NFT marketplaces, sell video games online, all that stuff. Okay, that's cool. But there are a lot of players in those industries. Cloud gaming has proved to be quite a dud recently. A lot of the big tech companies launched cloud gaming platforms to a lot of hype, and they've had, the follow through has been very weak. The reception's been very weak. All the gamer friends I talk to are very disappointed by those cloud gaming platforms. So any cloud gaming dreams that GameStop has, I think, are pipeline dreams. If Microsoft can't pull it off, GameStop's not going to pull it off. The NFT game, okay, that's interesting. Create NFT marketplaces. I love NFTs. I think there's a big future there, but is the timing right for that right now? Is the market really ready for NFTs? The NFT market is absolutely crashing. Sales are down, I think, what is the stat, 98% from their peak. And not showing any signs of recovery. And cryptos are having a tough time right now. The world's concerned about energy prices. The world's concerned about a war. The world's concerned about food inflation. The world's not really concerned about NFTs and little buzzy drawings right now. So I don't think that the timing is right for that. And I also believe, even if the timing were right, a very competitive marketplace. A lot of people are getting into NFTs. It seems like everybody is getting into NFTs these days. So that creates a lot of competition. What is AMC doing? Okay, they're still a movie theater chain, and movie theaters are they're doing all right. Post-COVID bounce, but the post-COVID bounce has been much weaker than I would have expected. I thought it was going to be a bigger bounce based on the pent-up demand. You're still seeing streaming take a lot of share of viewer time based on the Nielsen reports that I look at every week. And, they're trying to accept cryptos and kind of play into that crypto crowd, and that's cool, but again, tough uphill battle here. So yes, these companies are doing what they should be doing. That doesn't mean they're going to succeed. It doesn't mean they're going to succeed. And I think it's going to be I'm not ruling them out. They absolutely could turn these things around. But it's going to be very hard. And to bet on it is a wild card bet. And I don't know if they succeed. I would not give them a greater than 50% chance of succeeding. If they do, I will tip my hat and applaud them and say, fantastic job, good for you. I love it when that stuff happens. That makes me super excited. But right now, as an investor, as an investment analyst, I don't see the risk reward in those stocks really making a lot of sense. And so I continue to avoid them. And another aspect of it is the valuations are pretty bloated. I mean, GameStop, let me check. It's a $10 billion company, right? You know, and it's going to do $6 billion in sales this year. So that's only like a 1.7 times sales multiple, but it's going to lose $5.50 in earnings per share. It's going to lose another $3 next year. So, I mean, that $125 stock price doesn't make, a tremendous amount of sense. You look over at AMC, and what's the market cap there? So I had to reference these things because I don't look at these companies.
No, of course, yeah.
There's $7.5 billion on the market cap over there, and what are they going to do in revenues this year? They're going to do $4.5 billion, so 1.7 times forward sales on that. But again, $14 stock, $15 stock, going to lose money this year, going to lose money next year, going to lose money in 24, going to lose money in 25, based on the consensus analyst estimates. So you got a 1.7 times sales multiple for a company that isn't growing very quickly and is going to lose money for a long time. So what I'm saying is that baked into these valuations of these meme stocks that are executing the right strategy is a high probability of success. I don't think that valuation calculus makes sense. So if those stocks were to come down and the implied probability of success move below 50%, then I'd be interested in them because then the risk reward starts to make sense. But at current levels, the risk reward doesn't make a lot of sense to me. So despite these companies executing the right strategy, I continue to just avoid those stocks. I think there are simply a lot better opportunities in the market right now.
Does being a quote unquote meme stock help or hurt in this kind of leveraging and restructuring that these companies are trying to do right now?
Well, it helps. These guys would have 0% chance of restructuring and turnaround if they weren't meme stocks. They would not be able to raise adequate enough capital. They would not be able to attract enough talent, and any turnaround dreams they had would be burnt through bankruptcy. Because turnarounds require a lot of cash, and these are money-losing businesses. They needed to raise capital. Being a meme stock allowed them to do that. So I think that there's no argument. Being a meme stock helped GameStop, helped AMC, and helped anybody else that's trying to capitalize on the meme frenzy.
Awesome. Well, that helped answer some of my questions on that. But we also have some fan questions that we want to get to today. Randy Castillo asks, hey, Luke, can you comment on Michael Burry predicting 1,800 S&P levels by 2023?
Right. Okay. Yeah. So I think Michael Burry, and I wasn't fully aware of this argument, but I believe that the logical backing for it is the elevated price to sales multiple in the S&P 500 versus history. The problem with that, and I think it's like 1x versus 2x, I think the problem with that is you can't compare valuation multiples in the 2010s and in 2022 to valuation multiples of the 80s and 90s. And the reason for that, you know what? Let's do another screen share. One more screen share. The reason why you can't do that is if we look at our 10-year, which, by the way, the 10-year Treasury yield, I love what I'm seeing there for bulls. You see this? It kind of looks like a cresting top here.
Yep.
Looks like we could come on back down. That would be very bullish for stocks. But anyways, let's look at this all-time timeline. Okay, let's get rid of the log nature of it so you can actually see the. So I believe the Burry analysis, at least the little bit I read about, and I could be completely wrong if this is the basis for the analysis. If so, please correct me. I did a brief reading on this, very brief. But he's comparing the price to sales multiple of the market during this era from let me get a line going here and we can kind of from here, and let's do that again to the 90s. Let's go here. Okay. The problem is that in here, the 10-year Treasury yield was 8%, 9%, 10%, 7%, 6%, 7%, 5%, 6%, 7%, 6%, 5%, 6%, 5%, 4%, 5%, 6%. The price to sales multiple in here was being benchmarked to a 5, 6, 7, 8% 10-year Treasury yield. Today, and throughout the 2010s, we're at 3%, 2%, 1%, 2%, 3%, 2%, 1%, 2%, 3%, 1%, 2%, below 1%, 1%, 2%, 3%. We are in a 1, 2, 3% 10-year Treasury yield. So to compare valuation multiples from this era to this era makes no sense. The call for the S&P 500 to collapse to 1,800 would be relevant if and only if the 10-year Treasury yield goes to 5%, 6%, 7%, 8%. In the event that happens, the S&P 500 could very easily collapse to 1,800 because as go yields, valuation multiples have to adjust. But so long as we're in this 1, 2, 3% 10-year Treasury yield range, and I just showed you that chart about that kind of cresting, I think we come down in the 10-year yield as inflation accelerates. So I think we're going to be stuck in this 1, 2, 3% era. Then you're not going to see valuation multiples go back to what they were in 1980 and 1990. It just makes no sense. That would imply an enormous equity risk premium, and that enormous equity risk premium will not exist in the marketplace today. So I don't think that argument makes much sense if it does indeed involve a comparison of valuation multiples from 2022 with the 10-year at 2.8% to valuation multiples in the 80s with the 10-year at 7%. Makes no sense. It makes sense if the 10-year today goes to 7%. I don't think it's going to happen. If Burry's calling for that to happen, then that's an entirely different argument. But just on the basis of where yields are today, there's 0% chance the S&P goes to 1,800.
Well, hopefully you alleviated Randy's concerns. CS Low asks, another great show, Aaron and Luke. Thanks. The faster things get worse, the faster things get better was how Aaron summarized what Luke said towards the end of this week's show. Question for Luke. How much worse? Another 10 to 15% drop? Question mark. And for how long? Another few months, longer, shorter, before we see things starting to turn around for the better? Will the turnaround, when it comes, be a gradual and choppy one, or will be it quick and steep? And how can we be sure that the turnaround is real and not a fake one? Thank you.
Right. Yeah. So great questions and tough answers. Honestly, you hate to say that, but I can't really give you exact answers to any of those questions. I think that we are in the midst of what could be a turnaround right now. The things to look for are inflation. You want to see that trend decelerate. Yields, you want to see them top off. Valuations, you want to see them come down to historically normal levels. We're getting all three of those right now. And the Fed, you want to see them continue to pivot dovish. We're getting all four of those right now. If those four things continue to evolve in a way that makes sense, that is bullish for markets, then stocks continue to go higher from here. Is it going to be fast? Is it going to be slow? I think the market rebound is going to be gradual, but it's going to feel very fast in those certain hypergrowth stocks that have been really crushed significantly. So I think we're witnessing a market turnaround right now. Whether or not that is true, we'll find out, next week, the week after that, the week after that. And if it's not true, how much further could we fall? I don't see that much more downside, honestly. Things feel pretty washed out from a valuation perspective. Again, I showed you the charts that were below historically normal valuations. The equity risk premium has been blown out. I think we're looking at close to valuation bottoms. So now you got to look over at the earnings estimate side of the equation. And I don't think those come down much. I think they come down a little, but not much. Even so, if they get vastly reduced, normally that's offset by some multiple expansion on the multiple side of things. So I don't think that stocks are going to get crushed from here. I think that we're down, we were down 20% on the S&P. Maybe this tops off at 30. I think maybe another 10 to 15 points is probably a worst case scenario. I don't think that's going to happen. But given that the upside potential here is so enormous, especially in some of these stocks where I think they can rally 100%, 200%, 300% in a flash and then proceed to be even bigger winners in the longer term. The risk reward profile here is really attractive in my opinion. Barring an economic collapse, which I don't think we're going to get, I think that being in stocks is the best move today.
Gotcha. Ronnie Lahr asks, hi guys, pretty much all the big vertical farming companies I could find are still private. Any interesting leads on publicly listed startups? Thanks.
Oh, brother, why'd you have to ask that question? Yes, there are some publicly traded vertical farming stocks, and I cannot say their names on this podcast. I apologize. We run a research service that people pay for to access our research and some of our picks, and we're putting together a very in-depth vertical farming research report right now as we speak. We have some picks in the sector, so I can't say their names, but there are a couple of publicly traded ones out there. Not all of them are great. But there are some fantastic picks in the space. There's definitely ways to play this, and I'm sorry I can't say more, but yeah, that's that. I'm gonna bite my tongue now.
That's fine. Well, shifting again, Tina Tran asks, Luke, you suggested to buy Arrival stock, and it's dropped 90% in 1 year. Any new suggestions there?
Yeah, it has. The Arrival stock has been crushed over the past. When did the crash start? I don't know. The crash started a while back, and it was really high, above $20. That stock was, and now it's down below $5. It's a penny stock, technically. I absolutely love Arrival stock at current levels.
Okay.
This company, and based on all the engineers I've talked to, people in the automotive space, people in the electric vehicle space, people in the autonomous driving space, they are doing some really, really innovative stuff. It is a massive risk. They are trying to reinvent the automotive manufacturing process. Take out these giant factories with these huge freaking manufacturing lines and replace them with tiny factories that are run by robots. They call them robotic cells. And just basically the car goes from cell to cell. It's transported by robots from cell to cell. Once in the cell, robotic arms put together the piece of the car that needs to be put together in that cell, and then a little robot transfers it to the next cell. So it's just completely autonomous factory. That is a huge undertaking.
Yeah.
If they succeed in that, if this micro factory can be a proven success, then it's going to revolutionize a $1 trillion automotive market. Completely revolutionize the way we make cars. At a time when we're trying to make a lot of electric vehicles, at a time when we're trying to make a lot of autonomous vehicles. So it's a revolutionary, groundbreaking technology at a perfect time. The risk is, does the tech work? Are they going to be able to do it? And the stock has been crushed because they basically delayed the validation of that technology. Microfactory was supposed to be up and running back in 21, got delayed, but microfactories are going to be up and running this year. And the most recent quarterly earnings report said that they actually have completed cars, the construction of cars with their microfactory. So we're going to get more data throughout the year on if these microfactories are legit or not. If that data is positive, and based on the talent that I've seen the company has, I think it can be very positive. If that is positive, this stock is going to fly. I mean, yeah, honestly.
Yeah.
There's a reason it was a $20 or $30 stock at one point in time. Because the technology is truly groundbreaking. And it could easily get right back to there if that technology is validated in the back half of 2022 with these microfactories. Not to mention, this company's got a massive order and massive backing from UPS. So, you know how Rivian has kind of been selected as the Amazon's horse in this race? And the Saudis have backed Lucid. Well, UPS has backed Arrival.
Okay.
And they're basically saying that, okay, if Arrival scales and works, and we're going to use their vans and their vans only for our fleet. That's massive. You know, that is the same type of order that Rivian has from Amazon, and everyone likes to hang their hat on that order for Rivian. Why is no one hanging their hat on it for Arrival? Liquidity concerns, I think, are overblown. The company has raised a lot of capital. That's another reason the stock has come down. They had to do dilutive financing, so that definitely hurt shareholders. But now they have that financing done. There's a lot of capital on the balance sheet. They're ready to scale. I really like Arrival stock here. It's not without risk. This thing could go to zero easily. But I think it could go to 20 or 30, 40, 50 bucks pretty quickly in the event that these microfactories do work. So I love the risk reward profile there. Treat it like a VC opportunity. Treat it like a startup opportunity. VC investors take a lot of bets because a lot of times their picks don't work out, but the ones that do work out have enormous returns. I like the probability of success here. I like the risk reward profile. I think they could do something real special. So Arrival stock, very bullish on it at current levels. Very.
Well, great insights for our listeners and HCI investors as always. Luke, do you have any last words before we wrap this week?
S&P 500 is now positive on the day. NASDAQ is up 43 bips, and Dow is trying to get back there. We were down big about 2 hours ago. Now we're creeping into positive territory, solidly positive for the NASDAQ. That follows the best week since November 2020 last week. Very strong rallies on Thursday and Friday. Looks good. Things look good. We'll check in next week. I could be completely wrong, look like an absolute idiot, but that's what you do in this line of work. You got to take shots. If you don't take shots, you don't make money. So we're taking some shots. We like what we're seeing. We're pretty positive, and especially so on hyper growth stocks that have been washed out, that have very bright futures where the insiders are buying. Give me that 4-prong attack, and I'll give you, that's a stock I want to own right now. SoFi, for example.
You're back. Well, thank you everyone for listening. Please, if you have any questions or comments for Luke, leave them in our comment section. We love to hear your feedback on topics you want us to cover, and also to see if we can ever answer any of your burning questions. Until then, please don't forget to like and subscribe, and we will see you next week. Bye, all.